Okay, let's get started. Sorry, I was just having a look at the retail sales figure that came out today, much anticipated, and did surpass expectations there with core retail sales coming out at 0.6 compared to a 0.4 estimate. So it would be very interesting to see how markets react to that today. Anyways, good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm an analyst here at Options Play. And today I'm going to be walking you through how we are viewing the current markets. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, as usual, will be starting off with the major indices. And like I just mentioned, retail sales just came out. So it'll be good. It's always good to know where the key levels are and how price will be trading relative to them over the next few days. We'll be moving on to fixed income and commodities. And on the fixed income side, we have seen yields pull back slightly in the last few sessions. That being said, we are seeing more signs of consolidation and again, a possible rebound higher for yields. Commodities, we'll be taking a look at gold and oil, which is breaking out to the upside, and that will likely fuel some energy names over the next few days. We'll be taking a look at the sector rotational model. The weekly models are seeing what sectors have a long-term outperformance over the market and are underperforming the market. I have one subsector of interest for you today, and we'll end today's session with some bullish and bearish market observations. So starting off with the S&P 500, we can see here, if we take a look at the price action or the recent price action, the S&P did manage to recover after dipping all the way just shy of 380, which was our support area that we were looking at last week. It did manage to recover all the way to around this 404 area yesterday, and there was honestly yesterday it did look like a perfect pullback and failure of a retest at a previous support level. And if it weren't for the retail sales figure coming out today, I think we would have probably seen a bit more downside back to this 380 level. Right now, last I checked, price is set to open a little bit above this 404 major support area at around 406. And that is a very optimistic sign here for equities. But I will say that this gap up higher is pretty much due to, one, not just retail sales, but also the fact that having a better than expected retail sales figure indicates that consumer spending hasn't actually slowed down all that much. So it is traditionally a positive for equities and consumer spending remains elevated. But, I urge you to take a look at the bigger picture here. And what, we spoke about this before. One of the predominant themes of 2022 is the rate hikes. And if consumer spending is still elevated despite the rate hikes that we've already seen, it kind of gives a green signal for the Fed to be a bit more aggressive with their strategy, because if consumer spending remains elevated, it means that inflation is going to remain elevated to an extent. So while I do think that, positive retail sales figure is definitely a cause for some short-term optimism, and we may see that short-term rally higher, especially with price approaching this oversold condition on the daily time frame, I don't view it as a strong enough bullish fundamental catalyst to change trend. If anything, it just tells us the ball hasn't dropped when it comes to spending, and it should have dropped by now. And I'm a bit more, not to be a pessimist, but I am a bit more concerned about the fact that the rate hikes maybe aren't working as well as they are intended to, and are we going to see more aggressive 50-point hikes in the future? So short-term bullish or short-term relief for equity markets this morning and over the last few sessions. But again, something just to be made aware of. I don't think it's long-term positive news just yet. So in terms of the key levels, obviously the 404 area would be the key level to be looking at, but I'd also be looking at the 21-day exponential moving average. It has provided resistance in the past, but if price manages to break above that, the next key resistance area is at 428. My downside target remains at around 380 for the S&P 500. Should we start to see some bearish price action at these resistance levels, and that is in line with the 38.2 fib retracement level as well. So moving on to the NASDAQ 100. So the Qs, a lot more volatile, have been underperforming the S&P and the Dow for 2022 so far, but already we are seeing some relief in price this morning. And like the S&P 500, it did look like there was, a classic breakdown and a retest, and a failed retest, if anything, based on yesterday's price action. But today's news does bring price a little bit higher. So the next key level that I'll be looking at here for the NASDAQ 100 will be at the 316 area that has provided support in the past, so it may turn into resistance, but also keep an eye out for the 21-day exponential moving average, which could also provide a dynamic resistance level here. And moving on to small caps. So looking at the IWM Russell 2000 ETF, this is really all about the Fibonacci charts, or Fibonacci drawing here on the weekly time frame, where you can see price is clearly respecting its fib levels at 210, 188, and even at 170 at the 50% retracement area that it did manage to touch towards the end of last week. Price again set to open up a little bit higher, so you may see that short-term rally, especially with price being so oversold. It was probably about time to see a short-term rally to the upside here for small caps. And in terms of where the next resistance area would be, I'll be looking at around between 185 and 188 as a possible area of resistance. So 188 did provide support in the past. That was a 38.2 fib retracement level, but 185 also was a minor area of support as well a couple of weeks ago. But overall, I'm still bearish on small caps, and they have been underperforming the large cap names. So I wouldn't be surprised to see bearish price action there before a continuation lower, with the major support area being at 170, which it did touch last week. Okay, taking a look at the VIX, and some good news here for the VIX. Finally managed to break below 30. And, I mentioned last week that the longer the VIX stays above 30, the more likely we are going to see a relief rally in the next few days. And that is turning out to be the case, especially with the VIX now falling below 30 and hopefully moving back to more manageable levels where we see less correlation. And it just becomes a lot more easier to trade at these levels. It becomes a lot more easier to diversify between bullish and bearish bets. Obviously, with the VIX at above 30, there's a lot of systemic risk. We tend to see a lot of, no matter how good the technicals or the fundamentals are for a company, we tend to see a broad-based decline. Whereas when the VIX falls from these areas, there's a small period of a broad-based rebound. There's still some relatively high correlation, but as it moves lower and lower, we tend to see that correlation dissipate and just much more favorable trading conditions. So good news coming from the VIX, and hopefully it can carry on moving lower. I do see this trend line as a potential target here for the VIX in the short term. And moving on to yields. So yields, over the last few days, they have pulled back ever since yields touched at the 320 basis point level, which was our target for, I would say, a couple of months now. Yields have pulled back to its 21-day exponential moving average, starting to find support, as you can see, a bit of consolidation, but lack of upside momentum makes me believe that we may even see a small break below this level, and maybe even a revisit to around the 270 or just above 270 basis points here. And I wouldn't be surprised to see more of a base formation. I'll be surprised to see yields move that much higher. And it's not surprising to see as well the lack of upside momentum here after such impressive, well, I don't want to say impressive, but such an extended run. So look for maybe more consolidation at that area, but lack of upside momentum does indicate maybe a possible break below its 21-day exponential moving average, and a short-term move to around the 270 basis point level. And that brings us to bonds. So bonds, long-term decline, long-term bearish trend. As you can see, multiple support levels broken. And last week, the price did come very close. Well, it did touch the 112 target area, but immediately managed to recover a little bit higher. I did expect a further rebound, to be honest. I was thinking that maybe TLT would reach that 122.50 area, which would provide a much better shorting opportunity. That has acted as resistance in the past, as you can see on the weekly time frame, and support as well on the weekly time frame if I zoom back there. But price is already rejecting its 21-day exponential moving average, and it is showing some bearish price action here. But if yields manage to break down like in the previous chart, we may see a revisit there before maybe another revisit back to the 112 area, which does seem to which there's a possibility of that area holding as a base for the near future. And taking a look at gold. So gold, ever since price managed to break below 176, it's been on a very bearish trend over the last few days and immediately reached our target at 171. Initially, it did find support, but managed to break below that, and it touched at 168 area, and it is finding support at 168, set to open higher here. So this is definitely a key area, and I would consider this to be more of a zone than a specific price between 171 and 168. But with price finding support here, the next area of resistance for gold would be at around 176. And especially if we see the dollar pull back a little bit, we know the dollar has been overextended. I'm still fairly bullish on the dollar. I think the fundamentals do point to having an elevated dollar when you compare it to the basket of currencies that it's normally compared to. There's a case to be made for dollar strength to continue, or to at least remain where it is. But if the dollar does lose some momentum, I wouldn't be surprised for gold to continue higher, back to maybe even the 176 previous support zone. And taking a look at crude. So oil has now, it has broken out a little bit above that 112 area, right? So this morning, you can see here, there has been a breakout, but there is still another resistance area at around 116 for it to clear before we see that revisit to 128. And one of the bigger reasons for oil breaking out is simply because there have been some regional shutdowns in China due to COVID, and there are some very good numbers in terms of a lack of COVID cases in China that facilitates in a reopening of those areas, and that will most definitely increase the demand here for oil. So it is more of a fundamental play, and we'll have to see how that plays out. But from a technical perspective, 116 is still that area for oil to clear if you want to see that move to 128 or a breakout higher. And taking a quick look at Bitcoin. So the very interesting chart that we have here, and despite its recent poor performance, I actually think there's a case to be made for a breakdown here. So if we have a look from this is actually pandemic lows, all the way to all-time highs at around 68,000. We can see here that price did form the topping formation, and it has pulled back to an area of major support at around the 30 to 32,000 area. Since then, price has been fairly range-bound, but managed to breach that support level last week, and managed to breach below its 61.8 retracement level as well, which coincides with the support area. So it did breach it, but it managed to recover the last few sessions, and is now retesting this 30 to 32K previous support area, possibly turned resistance. And if you take a look at the lack of momentum in this rebound, it does lead me to believe that we may be seeing more downside in the near future for Bitcoin. Obviously, the terror shock did play a part in this decline, but overall, there hasn't been a strong enough rebound from this 25, 26K for to provide that evidence of a break above that 32K previous support level, possibly turning resistance. And at least in the short term, I do think a revisit to 26 to 25,000 area could be on the cards here for Bitcoin. There's just simply not enough momentum where there should be more momentum if there was going to be an upside break. So taking a look at the sector rotation chart, again, this is the weekly chart, just to give you a better overall understanding of the longer term rotation that is happening within the S&P 5, within the sectors of the S&P 500. We have 8 sectors in the improving and leading category. We have 3 sectors in the lagging and weakening category. And taking a look at the energy sector, we saw that severe loss of momentum when oil was consolidating for a couple of months. And despite being the best performer in 2022, energy did lose a lot of momentum, and it is heading towards a weakening category. Now, that isn't a bearish signal at all. It just means that it didn't have the same momentum as before. And, as we know, with oil breaking out, I wouldn't be surprised to see energy start to find more relative momentum and possibly move higher back into, or more comfortably into that leading category once again. Staples, very strong performer. We know staples is a defensive sector. And again, one of the predominant themes in 2022 is rotation out of growth and into value and into defense. So staples performing well does correlate with that thesis. We have utilities in the leading category, but starting to lose some momentum, but still well within the leading category. Real estate as well, losing momentum, and materials. Materials not losing too much momentum, but not showing a lot of rotation, but healthcare as well, losing some momentum. But again, not bearish cues at all. It just means that it's more of a relative pullback against the S&P 500. In the improving category, we have communications, which hasn't shown a lot of promise, not a lot of rotation there. It's been in the improving category for quite some time. I'm still quite bearish here on communications. And taking a look at the lagging category, we are seeing a rebound in financials and a slight rebound in technology and discretionary as well. That being said, it's not a huge rebound. We'd want to see a lot more rotation for us to change our bearish outlook on these sectors. But when I look at financials and when I look at yields and how high they've risen to, and normally financials tend to do well when yields rise, but the financials haven't been able to take advantage of higher yields. So I do think there's actually a lot of room for improvements in financials once we find support, but we do need to see more confirmation of that, in my opinion. But definitely a sector or names within that sector to put on your watch list in the near future. So taking a look at some sectors of interest that I have. So we have the healthcare sector first, again, another defensive sector. And price has been range bound, right? We can see here that there's resistance as well at 142, 143, but there's a major area of support at around this 125 area. And especially on the weekly time frame, we can see how many times price has bounced above that area. Again, even last week, strong rebound from that area, continuing higher this week. So I do think it provides that evidence we need for a revisit back to 131, which I would consider more of a minor level. But if that level clears, 136, 137, that's back on the cards for healthcare over the next couple of weeks. So definitely one to keep an eye on, especially with longer term momentum as well, improving. Shorter term momentum approaching an overbought condition. So we may see, a pullback in the trend over the next couple of days or in a few days' time. But it is good to see that longer term 50-period CCI improving, which, and again, provides evidence of a revisit back to 131 and even possibly 137. And taking a look at staples. So staples we saw has a lot of momentum in the relative rotation chart. And what we can see here was this very strong move from around 72. Price broke above that trend line, retested it on an intraday level on multiple occasions, found a lot of momentum to actually break above the 78 previous swing high, found support at that area, consolidated for a bit, and looked like it was moving a lot higher, but did run into resistance at 81. And that's when we started to see volatility pick up across the board. And we have seen, staples as well decline, like all the other sectors, back to this area of support at around 76. Now, there has been multiple attempts to breach below that area, but it has held its support quite well. And the last two sessions have been quite bullish in terms of price action. Prices, again, peeping above its 21-day exponential moving average. So I'll be looking for a move back higher here for staples, possibly to 78, but even higher, maybe to 81. The one thing to say about that, though, is Walmart. I think Walmart released earnings and didn't do too well, down 7% at least. So, and that's part of the staple sector, makes up a big chunk of its staple sector. So we may see an initial knee-jerk reaction here this morning, with price maybe opening a little bit lower before we see a move higher here for staples. But the next area of support would be at around 73, should we see a sizable move lower. So moving on to the subsector of interest that I have for you today, that is XRT, which is the retail ETF. So obviously retail, in the headlines today with retail numbers coming out a little bit better than expected. But what this tells me, like I mentioned earlier, is short-term optimism, but still, a longer-term decline, in my opinion. And investors, the markets have been pricing that in. There's been a longer-term bearish trend over the last few months. And even though price did manage to break below that $70 support level, it was looking like it was actually rebounding. And yesterday's price action was a little bit bearish, largely due to some recession fears. But I wouldn't be surprised to see XRT opening higher, retesting 70, possibly even breaking above it. And, it depends on how long this relief rally can last, but I wouldn't be surprised to see a revisit to that $80 level. But again, overall, the trend here is still bearish. And I would probably view this relief rally as a good shorting opportunity once I see some bearish price action. If we take a look at the weekly time frame, the further higher it moves, the closer it moves to that 38.2 Fib retracement level, the more inclined I'll be to short this name. Again, I just don't think retail is a space to be in right now in an interest rate hiking environment. And even though retail sales are better than expected, I do think it's more of a short-term rebound or short-term bullish signal rather than a longer-term or medium to longer-term bullish signal. The next area of support that I'd have here, should price reach that 75 area, would be the 50% retracement level at around 65, which you can see it did act as support very recently, this area. So moving on to some bullish market observations. First is Visa. So Visa is higher today, thanks in part to MasterCard data coming out with, again, high consumer spending. And we can see that is definitely a bullish sign. So we can see price has found support at 196, between 196 and 192. It's almost forming like a bottoming formation. I wouldn't really call it a inverse head and shoulders, more of just like a triple bottom. And even though it showed a lack of momentum yesterday to break above Friday's high, it will be breaking above that this morning, the last I checked. So a good risk to reward bullish entry, in my opinion, with the next target being at 221, which is the resistance or the top of this range that price has been stuck in since around September, October last year. Taking a look at Caterpillar, we saw this very strong trend, this very strong move all the way to 236 and a very quick reversal back down, broke back below its 222 resistance area and came back to revisit 205. Then we did see a retest of 222, a failed retest, and price came back to the 205 area of support again. Price action is looking a little bit more bullish. We can see shorter term momentum is improving along slightly with longer term momentum. And again, from a risk to reward perspective, I do think this is a good bullish entry point for those that are looking for, a bullish trade, I think it's a good bullish entry point for a revisit back to the 222 resistance area. And taking a look at advanced auto parts, earnings is coming up soon, but just if we ignore earnings for a bit and just have a look at the chart, you can see here the price has found support near the 200 level on multiple occasions. It has held quite firmly as support, multiple attempts to breach below that level, but none successful in recent days, and a lot of momentum here in the last couple of days to break back above the 210 level, breaking back above its 21 and 55-day exponential moving averages. So it'll be interesting to see what happens here. We may see a short-term retest of 210 before a move higher, but still, in my opinion, again, a good risk to reward bullish entry point. And for those that being said, we do see that there's earnings coming up, so that is the one thing to be made aware of here. But again, it could be another good earnings pick as well, a bullish earnings pick. So taking a look at FedEx. So FedEx, longer term bearish trend. We can see lower highs, lower lows forming, except for recently where price did form a bottom at around, a base at around 200. Now price has, really has failed to kind of make a new clear lower low. Yes, it did breach below 200, but it's not a really obvious breach. Price immediately recovered back above the 200 level, but it's already finding resistance at its 21 and 55-day exponential moving averages. You can see here the 21-day EMA did act as resistance in the past, and more recently the 55-day EMA. And there's just a lack of upside momentum, even though we saw, the end of last week was a fairly bullish couple of sessions. That hasn't really been the case for FedEx. Yes, it moved slightly higher, but already rejected that 55-day exponential moving average. So just an overall lack of momentum. And I wouldn't be surprised to see a revisit back to the 200 level, or possibly even a breakdown lower to form a new lower low. The next clear area of next clear key area, I should say, would be just above 160, which was at the pre-pandemic level here for FedEx. But as you can see here, the weekly time frame does have a more clearer picture of that bearish trend. So moving on to charter communications, part of the communications sector, which, like I mentioned, I am still quite bearish on. And we saw this huge downside move right ahead of earnings. The CCI, the 50-period CCI almost reached minus 400. It was very, very, very oversold. But price did manage to recover, with earnings being a little bit of a catalyst back to the 21-day exponential moving average, but already showing a lack of momentum, some bearish price action at the 21-day exponential moving average. So I'd be looking for a move even lower here for charter. If we take a look at the weekly time frame, provides a much clearer picture of a potential target price here for charter communications. And the next area that I'll be looking at would be the support zone, which is a pandemic low of around 400 or so. But yeah, bearish price action, just a lack of momentum at its 21-day exponential moving average, and an overall strong bearish trend does lead me to believe there's still more downside in this name. And taking a look at Etsy. So Etsy, again, another strong bearish trend. And this one has been a bit more of a difficult name to time for a bearish trade, in my opinion. We can see it's been more of a grind lower. And yeah, price did pop up to the 160 area in the past, which was a previous key area of support on the weekly time frame. And it was a perfect, breakdown, failed retest, bearish price action, and a strong move lower. And even yet, the last few days price action, where we did see price pop back up to near its 21-day exponential moving average, but there's just been a lack of momentum, which leads me to believe that it's more downside here in the short term, even though we see price moving slightly higher this morning due to retail numbers. I'm still not convinced there's going to be a full rebound. And you know what? If price does move higher, and I'll be looking for bearish price action for a much better risk to reward bearish entry point. And the target price that I have for Etsy would be at around 71, 72, which was a support level in the past for Etsy. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you have a great trading week ahead. I'll see you next week.